Hello and welcome. We will get started in just a moment. Welcome again, and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. Headquartered in Fort Worth, Texas, we work with accounting firms across the country to deliver expert guidance in areas such as R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have questions specifically for our presenters, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, the PDF of today's presentation is available for download now, should you wish to follow along or reference it afterward. With that, let's get started. I'm pleased to announce today's presenters. First is John Gale. John joined cost segregation team at Source Advisors in 2022. A U.S. Navy veteran, he brings 8 years of cost segregation experience with expertise in fixed asset depreciation, tax research, and business intelligence dashboarding. John is a certified member of the American Society of Cost Segregation Professionals. Additionally, Imran Syed. Imran joined Source Advisors in 2010 and is currently the Managing Director of Energy Services. Imran is a mechanical engineer by trade and has more than 15 years of experience in sustainability and energy-efficient buildings. He is a registered professional engineer, a certified energy member, a lead AP, a HERS rater, an NGBS verifier, and an Energy Star partner. And lastly, will be Deb Roth. Deb joined Source Advisors as the Managing Director of R&D Tax Credits in 2009. Formerly with PwC and another boutique R&D tax credit firm, Deb has overseen more than 4,500 R&D tax credit studies in the over 20 years that she's focused solely on R&D tax credits. She is also a founding member of the National R&E Roundtable. With that, I will hand it over to John.
All right. So thank you for the introduction, Anne. This is what she was just talking about with my background. I always like to add something here. I love G5 college football, right? And watch it all the time. We deserve a playoff spot. So today we're going to talk about cost segregation. What is it? When does it apply? How it impacts our clients? What that financial impact is? Some of our history and legal support, and what we use as practitioners to classify that stuff, right? So what this really is by the definition that the ASCSP gives, is it's a tax strategy that identifies and reclasses real property assets that are associated with anytime you buy or build a building, right? The easy way to say that is when you buy a building, you didn't just buy bricks and sticks and land, right? You bought carpet, you bought cabinetry, probably decorative lighting, you bought asphalt. All of these things should be broken out from that initial purchase price. And why do we want to do that? You know, it improves our near-term cash flow for our clients. Shorter depreciable life, sooner deductions on that depreciation schedule. All of our clients like to hear that. So let's look in at what that actually looks like. And this is really, I mean, this applies to every study, but this is how we look at specifically a new construction study. Every building, if we start here on the left, every building has basically 3 cost buckets that flow into it when you build something. There's costs that come out of your owner cost. That's things like architecture, engineering, design costs, construction period interest. And then our general contractor, that's the person who really builds everything, brings all the people on site, all our subcontractors. They're the ones doing the real physical labor. And then we've got change orders on the back end of that. So out of those 3 buckets, generally your contractor will separate everything out into those 16 construction divisions that you see here. And then the owner, and then we combine all of those costs to break it out even a little further than that. And that's where the value of cost segregation really comes from. So your division 2, your site construction stuff, that'll break down into parking lot, landscaping, storm drainage. Some of it may even go into that initial clearing and grubbing, which could be land. Some of it should be allocated to your building, right? Things that are costs incurred to place that building in service. And then, of course, a big chunk can end up going to 15-year. Now, for the rest of it, the big ones we really see are the finishes, Division 9. Equipment, FF&E. A lot of times you don't necessarily need a cost segregation study to dig into that one. But where we really see a lot of the technical nuance comes in Division 15 and 16, that electrical and mechanical plumbing type stuff. That said, we can often get allocations from any or all of these buckets, and it just really takes one, identifying it, quantifying it, and then applying the correct cost methodologies and tax law to it, right? And so then at the end of the study, you end up on your depreciation schedule with a bucket of 39-year, a bucket of 15, 5, perhaps 7, and land costs, right? That you can defend. So when does this thing apply? We like to say the last 5 to 7 years. That's not, a hard and fast rule. If you have a little Airbnb that's 250,000, it's probably going to be 1 or 2 years, just because there's not enough basis there for the ROI to be worth it to your client. Whereas if you have a big manufacturing plant with $30 million basis, it might be even longer than that. It might be 12, 15 years. So higher basis tends to go a little bit further. We like to see assets that are depreciating over 27.5 or 39 years. Not to say that we haven't looked at like a site, like a truck parking lot with just fencing and asphalt and stuff, but those are a little more nuanced and something we would discuss on a one-off basis and how we would best approach that. 500,000 is a good starting point. It's a little easier with 100% bonus coming back. If we're doing an Airbnb, we do have specialty pricing to help those clients out so that we can get those to about 250,000 in a current year. So if you have anything around that bucket, it would be worth looking into for them, especially if they have income they want to offset. Now, as I said, it's anything acquired, constructed, expanded, remodeled, basically anything that's a building, right? And not something that you've owned since 1981. But the property does need to have a tax-paying entity. They can have government tenants, they can have nonprofit tenants, but they need to pay U.S. taxes. That being said, I've done these studies for buildings in the UK and in the Bahamas. As long as there's special rules, and there's definitely some technical hurdles we have to get over to do that. But if you're paying U.S. taxes, on that we can potentially get a reclassification on those buildings. And more complexity drives higher benefit. Your data center, your manufacturing facilities tend to come with a higher reclass percentage than a warehouse. Especially, let's say we got a warehouse with a gravel parking lot, and it's really just 4 walls and windows. There's not usually a whole lot to reclassify there. That said, it still most oftentimes will make sense for your clients. And when it doesn't, that we always point that out as well, and we talk through what that decision would look like, especially when you go back to them to present our findings or our estimates. So a lot of people think of this as something you just use on the front end, something for new construction or acquisition. But remember, we can do these. We can correct these old depreciation schedules with 3115 or an amendment, right? Excuse me. There's so if we look at it, of course, new construction, acquisition, it's great for that stuff. But it's also ideal when you have that study done. Now, when we do repairs, when we do dispositions, we know exactly how much those doors are that we're writing off. We know how much how much basis we have in windows, right? So we can actually do those dispositions and those repairs that might come with that big remodel down the road, or expansion, right? And then especially if we're going to do a sale, now it's much easier to calculate that basis because we've actually broken all those things out. So it's really helpful in a 1031 exchange, right? Because now we know what depreciation we have, what our gain is, what our loss is, right? We can quantify those things much easier when we've broken them all out in detail on the depreciation schedule, and what depreciation was allowable if we wanted to get into recapture. But I don't think I'm going to address that in version of the presentation. So I'll go back. It's really about addressing your property's depreciation needs over the whole life cycle of the property. Now, let's talk about the financial impact. Really, what does this mean to our client? And I kind of covered this a second ago. Faster depreciation means more write-offs today, better cash flow, more money in your client's pocket so they can go to Tahiti or reinvest it in their business, but also Tahiti, right? So lower tax burden, they can fund their business growth. And that's probably what I see most of our clients want to do with this, but everyone has different financial goals. This is just another tool in their toolbox so that they can you introduce more strategy and more ability to plan down the road when you have this type of study done. So what can we reclassify? Like I said, typically in 5-year, we see that carpeting, decorative lighting, break room sinks, computer room HVAC. And then in our 15-year, we see our asphalt landscaping and our retention ponds, right? And there can be a lot of other assets that go with that. We see guardrails. And I say retention ponds, that can be a dry pond or a wet pond. Just can't be a natural man-made lake, right? And this is a big one. We all talk about this one. CPAs sometimes misunderstand the qualified improvement property. These are improvements made to the interior portion of a building, of a non-residential building, after the building is placed in service. And one thing I like to point out here is that not all enlargements are true enlargements, right? So let me say that another way. If we have a warehouse and it's 30 feet tall, and I go in there and build a second floor, right? And now I've effectively doubled the square footage of that building, but I haven't increased the cubic volume, because if I build another story on top of it, or if I build another section next to it, that's a true enlargement. But if I've only increased the square footage and not the cubic volume, that's not a true enlargement. Okay. So let's talk about that total reclass of property by type. Again, we want to see the complexity, but a lot of times it comes down to the finishes. If they use that cheap stick-on tile flooring, that doesn't tend to drive as much benefit as the high-end luxury snap lock flooring. What type of site improvements? I like the warehouse example here just because one warehouse might have a gravel parking lot and the other one might be an Amazon distribution center with 15 acres of concrete paving. And so there's going to get vastly different reallocations. The business activity tends to drive this, right? So if you're an electrical contractor with a warehouse, that probably isn't going to drive the same benefits as that Amazon warehouse. Some of the things that affect this are whether it's ground up, new construction, whether you acquired an existing building, and the big one being renovations and tenant improvements, right? Depending on what kind of tenant's moving in there. So when the warehouses just make a lot of sense to me, especially we're seeing this a lot in the Northeast right now, when we're seeing a lot of people buy these warehouses and renovate them to turn them into data centers. And if we look over here at the chart, data centers are at the very bottom. These things are gold, because you're buying a very cheap building, a building that costs very little, and you're investing a ton of extra money in electrical and server equipment and probably HVAC, things that are going to support this new business. And so when we see something that complex or a simple building change to a complex building, we really see tremendous benefits come for our clients. That said, the warehouse, they're really simple, so they don't cost us as much to process. And so we can usually get to a good return on investment for your clients there as well. So, and I think I hit this a second ago, but we'll dig in a little more on this qualified improvement property concept. IRS considers treating QIP as 39-year property impermissible, right? So they want us to really classify everything. And this is really the biggest deal when we talk about 1245. So this is going to be the same issue that's going to come up with QPP. We shouldn't just be throwing everything into this QPP bucket or this QIP bucket when we buy or build something, or when we renovate something, right? Or build a production property. Since 1245 has much less favorable recapture, the IRS wants us to make an allocation on that. So what I run into and what I see clients do is they've put everything into QIP, and then they sold the building, and now the IRS wants to audit to see if they have recapture. Well, the IRS is going to want to know how much 1245 property was in that building. And because QIP is 1250, it faces different recapture. But once we've sold that building, 9 times out of 10, maybe more than that, we can't get access to that building to even do a study because we don't own that building anymore. And so now the IRS will either get to determine how much 1245 they thought, or just make an arbitrary assumption on that stuff, right? So it turns into a really bad fact pattern when we just put everything in QIP or QPP and we get audited on recapture. So that's definitely something we want to watch out for. The 1245 needs to be properly allocated as well. And this is what I was talking about a second ago with those enlargements, right? If we add a second floor and we just increase the square footage, that's not a true enlargement, okay? So no earthquake-related improvements. I'm not sure where your firm's located. That doesn't come up a whole lot. And the biggest part is, not all states do have bonus or QIP. And so if your client's in one of those states, then we really shouldn't just be throwing everything in QIP, right? You can end up in a really messy situation on the back end. So some of the misconceptions we hear: this is only for large businesses. Like I said, we have specialty pricing for our small taxpayers, people who just bought their first Airbnb. Any type of commercial property really might be a good candidate for this stuff. Some people say it's too expensive. When I said before, our ROI is usually over 10 to 1, and only when it's below 10 to 1 is when we have that conversation about, well, maybe it doesn't, the return isn't good enough for your client. Maybe there's just not enough dollars here to pursue this. But on most projects, we see that ROI get 10 to 1. I see them go to 100 to 1. I've seen them go to 300 to 1. So when you get to that fact pattern, it's kind of a no-brainer. It's risky. That's not true. When you have a trusted tax partner that can quote you every single case law that governs this stuff, your audit risk is really minimal. When you do a proper site visit, I would definitely advise to stay away from these firms that aren't doing site visits. They have the IRS audit technique guide says that a quality study should have a site visit. The American Society of Cost Segregation Professionals says you need a site visit. And the IRS really doesn't like to get into a study and then see that there was no site visit done. And unfortunately, our industry is seeing an uptick in people trying to complete those kinds of studies. And so, AI can audit a report pretty quick, and most of them are even stating they didn't do a site visit. And so I see that as probably low-hanging fruit for the IRS in the coming years. Now, like I said, you need to know exactly why you can qualify these. And this is really the meat and bones for you guys. This is a takeaway that you can use to understand how we make these allocations, or how to think through these allocations yourself on simple things, right? So the IRS's the primary test is, if something is a building, does it look like a building? Does it provide workspace that's more than incidental to the primary function of that building? This comes from Freightways versus Commissioner. They had a dock that was attached to a larger building, and there was work being done there. The client said it doesn't have walls, it doesn't have doors, it doesn't have windows, it doesn't look like a building. And the IRS focused on the function part of this argument, saying, well, it's to provide workspace for the workers. They move dock in and out. This is necessary to the normal function of this building. The IRS was successful, and so we have the appearance and function test. That's not to say that all of these all docks disqualify, but you really want to know what tests to walk through and how to make that allocation when you get one of these. Another big one we use is that accessorial test, right? Is that component necessary for the primary function of the building? Okay, so general lighting, fire suppression, anything that has to be there for that building to basically pass a health inspection code or an occupancy code to function with any tenant, that stuff's all going to be primary building components, right? But if it's more connected to a specific process happening in that building, so for that warehouse example, if I've got a functioning warehouse and I come in and add $3 million of electric to a $1 million warehouse, that building probably doesn't need all of that extra electrical to function. It probably needs a little bit of it because it gets tied in with the normal process, and they reroute the lighting and they put in new circuit breakers and stuff. So we probably shouldn't just allocate the whole new cost to it, but certainly some of it, right? Certainly a big chunk on that portion. Sole justification test. This is specific to HVAC. And I've seen a lot of practitioners misuse this test on electric or misuse this test on plumbing. but it's specific to HVAC, right? This comes from the grocery store chain Wiggly Southern Incorporated versus the commissioner. And the problem is we have to get over this this test of sole justification. So your general building HVAC isn't going to qualify. But, and I'm going to draw on this real quick for you guys. These, what you're seeing here, and I didn't do a great job there, but these are actually extraction fans. This is in a grocery store, right? So these extraction fans that we're seeing on the ceiling only exist here around this big box cooler, like you might see in a Sam's or a BJ's or Costco or some other big box grocer. They pull the humidity out of the air. So that's something that we can qualify because it meets that sole justification test, right? If this turned into an Amazon warehouse, they would have no use for these. It is specific to that. And the other ones we see, sometimes we see cold storage, clean rooms. We might see even just a PTAC in a server room that's not there for the health and comfort of the employees, but it's truly just servicing their internet equipment, right? Those things can qualify under the sole justification test. White cow. This is a huge one. This one goes all the way back to 1970, and even before cost seg was approved. Even before the IRS acquiesced, cost seg is a valid method, right? And I read these right from the slide because they're a little redundant, but you have to apply them all in order, and the court will apply them all in order, right? So can that property be moved? Has it in fact been moved? How difficult is removal? Is that removal time consuming? Any circumstances that show the intended length of a fixation of the property? Is it designed to remain permanently in place? How much damage will the property sustain upon removal? How is the property affixed to land? Because I have a shorter time, I'll talk through this a little bit more. They tend to apply these a little differently to different property units, right? So if we're talking about a wall, if we're talking about like a folding partition wall, we really want to look at, is it designed to remain permanently in place and that intended length? You're going to see out there these green zip walls and these dirt walls that are being marketed on their websites as these qualify as 5-year. And if you go dig into that, they're citing a private letter ruling, which we all know we can't bring to tax court, right? But if you dig in and go read about that private letter ruling, the only reason the IRS really focused on this intended length, and it was the only reason they allowed them to do this. It was because that client actually had moved these walls in the past, and they intended to move them, and that wasn't the only type of wall they put in their building, right? So they were able to show that yes, they put these in specific areas, they reconfigure them for the business use, because at the end of the day, I mean, all drywall really meets this test, right? But drywall is defined by a Treasury regulation to be a structural building component, and so we have to be very careful in how we meet that definition. Those sites that are claiming that it always qualifies are citing this white coat test as their proof, but there are very specific circumstances that allow us to take those assets, and clients get aggressive about it because they read the website and the website says I can take this, but as CPAs, that's not always defensible. So O3B, the one big beautiful bill. This is probably what people want to hear about most, and unfortunately we are still awaiting some guidance. So we still have to talk about this at a high level. I'll get into a little bit of the nuance of what we really need guidance on. The big part here is 100% bonus is back. And this is great for cost segregation, especially our industry. And it's anything that's placed in service on or after January 19th. I'm actually going to skip the rest of this slide for the sake of time because we're going to cover it in more detail on these two. But acquired property, this goes back to TCJA, right? We still have those binding contract rules. So if you had a contract that limited damages to less than 5% on January 1st of 2025, and you didn't close until January 30th, you might still qualify for that 100%. But when it's the other set of facts where, well, I closed on January 30th, I should get bonus on this. But there was I was on the hook for 10% of the purchase price back on January 1st. Well, now we have this binding contract, so you're actually going to be under the old regime, and you're going to be still subject to that phase down, which in 2025 is 40%. And that conversation stinks, but that's the right way to apply the code. So there we go. Let's talk about constructed property. The rules here are a little bit different, and I was at a conference a week ago where this got misquoted, so we'll go ahead and talk about it. this self-constructed property, this really comes down to a different section of those rules, right? It's when physical work of a significant nature begins. So we obviously want to place it in service after that January 20th date, but I had a client, and this was a very extreme example, where they started incurring costs in 2022. It was all design costs, it was all architecture costs. They had a loan, they were paying interest on it, but then they for one reason or another, because of planning, because of changes, they weren't able to break ground. So January 30th of 2025 came around, and they finally did their first physical work on this property. That's going to qualify for 100% bonus. And that's a great conversation to have with our clients. So it's really just navigating the nuances of these things and getting the right answer for our clients. Now, QPP, this is really where we need the most guidance, right? So this is going to be for property that's new production property, right? As long as it wasn't used in a qualified production activity between 1/1/21 and 5/12/2025, we need first use by the taxpayer. And at the beginning, we were hearing a lot of misunderstanding about this part. Some people were thinking that it was only going to apply to like refining or certain very specific production processes. But I've had a lot of conversations about this, and our opinion is that we think it's probably going to apply to most of those. If you go to Rev Proc 86, most of those 8756, you'll see that it's going to apply to most of those manufacturing asset classes. Anything that results in that substantial transformation of a product, right? Whether we're turning, crude oil into gasoline or maybe even food, right? Maybe we're turning a bunch of ingredients into an industrial kitchen where we're packaging it and sending it out to grocery stores. Maybe that's going to qualify. We think that's going to qualify. And one of the big exceptions here is going to be, this doesn't work for offices. It doesn't work for sales. It doesn't work for research and engineering, anything not related to the manufacturing process. And this came up when I was at the cost segregation conference a couple weeks ago. We were discussing, well, what happens when you have a big production facility and on half of it, you're using it as a warehouse, and then the other half, you're just doing manufacturing, right? So does that whole thing qualify for qualified production property? And it really doesn't cover storage, right? And so if that becomes the case, that's going to change everything about how manufacturers are building things. We're going to need to get this stuff out the door right away. If that's the case, we're going to use all of our floor space for manufacturing. We're not going to store anything in this facility. We're going to build buildings differently if that's the case. The bigger question is, and this one's going to be easy when we have, a separate manufacturing building, or we build a manufacturing building on the back of an office. But what if we built one big building and it's got offices and it's got sales and it's got research and engineering, it's got a lab, so it's really a mixed use space. Well, it clearly says that those don't qualify. And it's not clear in the current guidance if we can just use a percentage test, right? We need guidance on that, because those sales and research facilities, they usually have a different construction than the big open warehouse type manufacturing space. And so a square footage test is probably not going to be the way to determine how much of your building qualifies for QPP. But hopefully the IRS provides that guidance before we get to January here. So what does this look like? And I don't want to take too much of everyone's time here. I think I'm over. So what it looks like for us is we pre-qualify, we talk to you, we define that scope, we get you an estimate of benefits. That part's all free, and we give you a proposal to review with your clients. After that, once we're engaged, we can start getting more data. A lot of times we are going to need those costs. We're going to need, at least the address, the basis, and the day it's going to be in service, so we can apply the right tax codes to your estimate, right? But then we perform the study. We send an engineer on site. We take notes. We take photos. We document all this so that it's 100% audit proof. We review your costs. We review your plans, all the things that go with that, and then we review the report on the back end. We have 3 reviewers. First, it goes through a peer review. Then it goes through a senior tax level review, and then it goes through a quality review before we finalize that and send it back to you. And when we send it back to you, please, we do make revisions. What I see most often is, and I'm not encouraging this at all, it's always better when we get it on the front end, but you'll say, oh, we had another $100,000 of engineering costs or architecture costs that we didn't include. That's fine. We'll update that for free as long as that's within a reasonable time period. when we don't want to see is, oh, well, we incurred another 30% of construction cost that wasn't included. And so that can be a little bit different, but that we don't see that very often, right? And then on the back end, we offer audit support. So anytime that you're audited, your client is audited, we're there to support you with that relevant tax code, the white code criteria, all these case law things that allow us to make the allocations that we did. And we have the supporting documentation to back it up. So, and that takes us to our first polling question.
Yes, qualified production property includes space used for research and engineering. Is that true or is that false? This is our first polling question. You do need to respond to 3 of 4 in order to be eligible for CPE, that along with the 50-minute attendance. So they're starting to roll in.
Okay.
And it looks as if the majority say true.
I like that we put it so much further in here. It gave everybody a chance to get into the, we can't do them right at the beginning.
Yes, I think we are able to move on.
Perfect. Thank you, Anne, and thank you, John, for the presentation. So just continuing from where John left off, the next few slides will focus mainly on certain energy tax incentives and the impact that the Big Beautiful Bill had on some of them, both in regards to the sunset period as well as certain change in qualifying criteria and rules. Now, there's a lot of energy tax incentives that can be discussed, but I'm going to focus on 3 main ones: Section 179D, Section 45L, which is a residential tax credit, and within the investment and production tax credits, the focus for this presentation would be the solar and wind projects. And again, the goal here is not to do a deep dive into all of these tax incentives. We'll do a high-level update with the Big Beautiful Bill. But to begin with, 179D, as most of you might have already heard of, is a tax deduction that applies for commercial and high-rise residential properties. And high-rise residential properties mainly mean any residential building that's 4 stories or higher. So commercial buildings do not have any limitation on the number of stories. Residential do have to be 4 stories and higher. And for the longest time, that deduction used to be $1.80 per square foot. So a 100,000 square foot building was eligible for about $180,000 in tax deduction. And that stayed in place until the Inflation Reduction Act came in, and that increased the deduction to up to $5 per square foot. Now, there's 2 verticals under 179D. The building owner, who owns the property and has renovated an existing building or constructed a new property, is eligible to take that tax deduction. In case of a government or a non-for-profit building, since these entities are tax exempt, the design firms who worked on the design of the project, these are namely the architectural firms, mechanical, electrical, plumbing firms, design build contractors, all of these firms are eligible to take that deduction on those projects that they've actually primarily designed. Now, with that being said, and I've mentioned $1.80 per square foot was the deduction until the end of 2022. So you still have a chance to go back and retroactively take that deduction if a 179D study wasn't done in the past. For commercial building owners, you could file a 3115 and go as far back as 2006. For design firms, you do have that 3-year statute of limitation, and therefore you might have to look into that. And the deduction remained $1.80 per square foot until the end of 2022. The Inflation Reduction Act increased that deduction if a certain qualifying criteria was met, and that deduction was up to $5 per square foot. Now, the requirement, and this was the case with most tax incentives under the Inflation Reduction Act, there was a base tax deduction or tax credit, and then there was a bonus if prevailing wage and apprenticeship requirements were met. These are the Davis-Bacon wage requirements. So if a project met the PWA requirements, or the prevailing wage and the apprenticeship requirement, the deduction was up to $5 per square foot, not including the inflation adjustment. And if the project did not meet the PWA requirements, that deduction was about $1 per square foot. So there was again a significant difference in the deduction amount depending on PWA. What the big beautiful bill does is it continues with the deduction amount, but it does sunset 179D as a tax incentive, and that begins for projects that start construction after the 30th of June 2026. So basically 6 months from now, projects that start in July of 2026 would not be eligible for a 179D tax deduction. Now, again, the strategy here for most developers and builders are, if projects are already past the design stage and are about to start construction, they'll probably benefit from the deduction as long as the construction begins before the 30th of June 2026. Now, the counterpart to 179D is the 45L tax credit, which applies to all form of residential projects, whether these are single family, townhomes, or apartment projects. Pre-Inflation Reduction Act, which is pre-2023, that tax credit used to be $2,000 for every dwelling unit. With the Inflation Reduction Act, the rules for qualifying for 45L did change, with Energy Star or the zero energy certification being a requirement, but the credit amount did go up to $5,000 per unit. And so again, depending on the certification and the type of the building, namely, whether these are single family projects or multifamily, that tax credit range could be anywhere from $500 to $5,000 per unit. What the Inflation Reduction Act did was it took off the limitation on the number of stories, and therefore, even a high rise residential project was eligible for the 45L tax credit. The IRA did make one major change, which was the certification requirement. And what that means is that this could not be done on a retroactive basis. For a project to qualify for the credit, they had to be certified, and that certification required raters like us to be involved very early on in the design phase and throughout the construction project. Quick case study. Here's a multifamily builder, built about 144 apartment units. This was placed in service a year ago and qualified for the Zero Energy Ready Home certification, and therefore that's a $5,000 per unit, $720,000 in total tax credits. Now, the takeaway from this slide is just knowing what the sunset period is. As I mentioned, for 179D, it's based on the construction start date. For 45L, however, this is based on whether units are leased or sold prior to the 1st of July 2026. And therefore, completing that project is not sufficient. Those units individually have to be either leased or sold in order to take the tax credit. Now, you may run into projects where, a 5-building multifamily project, 2 buildings will be leased before the 30th of June. The other 3 would be after. You're still allowed to take the tax credit on those 2 buildings as long as those units are leased before July 1st, 2026. So the dates are similar, but the criteria is slightly different for 179D and 45L. Now, switching gears a little bit here, going into solar and wind tax credits. Section 48 is generally what it's known as. And among the qualifying systems under Section 48, solar was the most prominent one. Pretty much every solar project went after the 30% base tax credit. The big beautiful bill does change quite a few things with regards to these 2 qualifying systems. Everything else under Section 48 pretty much remains the same, or actually gets an extension, whether it's the biogas system or combined heat and power or geothermal. Solar, wind do get impacted quite a bit with the big beautiful bill. There's obviously this one pager that we are sharing here, but if I had to summarize this, I'd look into 3 buckets. The first one is, and this is the best case scenario, as long as construction begins prior to the end of this year, 2 things happen. One, you have a 4-year window for that project to get completed. So you don't have to worry about placing the project into service before the 4-year period. But also, and more importantly, certain requirements regarding the foreign entities of concern, and I'll go into this a little bit later on, would not apply, making that project a lot more easier to qualify for that 30% base tax credit. And then there's additional bonus tax credits as well. If a project starts construction between January of 2026 all the way through the 4th of July 2026, as long as it begins construction between that time frame, you still have that 4-year continuity. So again, you do have 4 years to finish the project. However, the foreign entities of concern restrictions would apply to that project, which means there's a little bit more documentation needed. And then the third bucket is the 4th of July projects that start after the 4th of July, in which case the project must be completed prior to the end of 2027 in order to be eligible for any tax credit. And so as long as clients are informed about these construction start deadlines, they are able to plan out things. Now, I keep saying the beginning of construction start date. Two tests apply towards that. If a project is a grid size large 1.5 megawatt or more, there's only one way to prove your construction start date, which is work of physical nature must have started. If a project is less than 1.5, which are generally a lot of the projects being placed on a commercial or a residential building, you have two ways to prove. One, you could start construction and basically say it's already started and therefore would apply towards whichever timeline it falls under. The other way is the 5% safe harbor rule, under which as long as 5% of the construction costs were incurred prior to that date, the project would be falling under that construction start timeline. Now, and I'm going to go a little bit quicker here, just so I make sure Deb has enough time for her slides. A couple of things to note here, and I'll go into the foreign entities of concern because that's the most latest thing that comes from the Big Beautiful Bill. But just to recap on what the Inflation Reduction Act brought in, all of these investment and production tax rates, whether these are solar, wind, geothermal, carbon sequestration, or biofuels, all of these have the ability to either sell the credits in the marketplace or use the credit towards tax liability. The other way is for non-for-profits and state local governments, there is an option to do an elective pay where they can go through an elective or a direct pay process and actually get a refund check back from the federal government. And again, that credit could be 30% of the cost of the project. So the takeaway is all of that still continues as long as the system is eligible for a tax credit. Now, I want to end with the foreign entities of concern because I do believe this is something that wasn't part of all of the previous tax regulations. Starting from 2026, as if projects start construction from 1/1/2026, one of the additional requirements of documentation that has to be shown is a portion of the cost of the project has to be from countries outside of these specified foreign entities. And there are 4 countries in particular: China, North Korea, Russia, and Iran. So if you have components coming in from any of these 4 countries, and China generally stands out because a lot of the solar panels are manufactured there, there has to be a calculation done to prove that no more than 40% of the cost of the manufactured products were sourced or manufactured in China. So as long as it's less than 40%, the project is still eligible for the tax credit. If it's more than 40% in 2026 and that number goes up to 45 in 2027, there are issues with eligibility for the tax credit. So again, as clients plan for projects starting construction 2026, one of the things we may have to ask builders and developers and installers are if they meet the foreign entities of concern restriction rules. And I mentioned this, and I'll go through this briefly. You do have 2 options to monetize these tax credits. One is the transferability option, where you can sell the credit. The other one is the elective pay option for non-profit and state and local governments. I should bring us to polling question number 2.
Okay, under Section 48E, solar and wind energy projects are subject to early sunset compared to other renewable technologies. Is that A, which is true, or B, which is false? Okay, they're starting to come in.
And just a reminder, please do keep sending questions on the Q&A tab. All right, with that, Deb.
Thank you, Imran. And just a big welcome to everybody today. We're happy to go over these topics. I'm going to try to flip through my slides on the R&D side rather quickly, and we're going to come up with the third polling question quite quickly here right after the first slide. So pay attention. It's going to be an easy question if you listen to the first slide. But anyway, I've been leading the R&D team here at Source Advisors for the past, I think 17 years. Happy to take questions even after today's webinar. Definitely reach out to your contact person at Source, and we're happy to get you in contact with somebody on the R&D team to answer any of the questions that may come up as I go over the next several slides. All right, with that, let's get started. The main thing that happened with the Big Beautiful Bill is that they introduced a new code section, Section 174 Cap A. And what 174 Cap A does is it relates to domestic R&D expenses, and it makes them fully deductible again for all taxpayers starting in 2025, for tax year 2025. So that was definitely greatly appreciated. In addition to the prospective help for all taxpayers, the Big Beautiful Bill also included a number of options for the smaller taxpayer to actually benefit sooner than tax year 2025. And we'll go over what those options are. The definition of a small business is any entity that has gross receipts in the prior 3 years, so 22, 23, and 24, that are on average less than 31 million, okay? And the other thing that came out of the bill was that all taxpayers, when they go into 2025, can decide on their 2025 return if they want to catch up or accelerate any of their unamortized amounts at that point in time on their 2025 return, or they can smooth it out on the 2025 and 2026 return ratably, or they can just continue the normal amortization schedule. When the bill came out in July, obviously we were really hoping to get some procedural guidance before the filing deadlines. Guidance did come out. It came out at the end of August, so there was quite a scramble there. But that is Rev Proc 2025-28, and that provides all the guidance really related to all the various elections and accounting method changes. One thing that didn't change is the old 174 is now 100% related to foreign, and the amortization is still in play. So again, 174A allows for full deductibility, and 174, the regular 174 original, still has the foreign amortization over 15 years. And here we go with polling question number 3.
Okay, the OBBBA reinstated a pathway for all taxpayers to currently deduct R&D expenses for tax years 2025 and forward. Is that A, true, or B, false?
All right, quick question. Can I float to the next slide, Anne, and keep talking since we're short on time? Maybe we can leave the polling question open.
We will do that.
Okay, great. All right, so related to Rev Proc 25-28, there was a lot of procedural guidance in there associated with how to make certain elections. The elections are associated with adopting 174 Cap A, and then also with the 280C election that's really related to R&D tax credits. So with the small businesses were able to actually get relief and go back to current deductibility if they elected and they want to for the 22, 23, and 2024 years. Those are sometimes referred to as the TCJA 174 years, right? Everybody had to amortize for those 3 years. So it would be a retroactive election that those small businesses, again, under the $31 million mark in gross receipts in that same time period, 22 through 24, that if your gross receipts were under the 31 million, you could then go back and determine whether or not you wanted to amend your 22, 23, and 24 returns and actually currently deduct. So that is an option for all small businesses. Now, you can't pick and choose. You can't say, I'm going to make that election for 22 and not for 23 and not for 24. It's an all or nothing. So you either go back and you say, I'm going to assume 174 Cap A was always in existence for me, starting with tax year 2022, or you keep your amortization. All right. It also provided, if we go flip to the next slide here, that the small business, by the way, the polling question, the answer was true. So hopefully everybody got that. That's the big news with the big bill, is that we got our deductibility back for our R&D expenses. But for small businesses, if you do want to elect to go back and amend your 22, 23, and 24 years, if you amortize, you want to go back and undo the amortization, you do that through an election statement. So there's no 3115s, but you would do that with an election statement that is attached to each amended return for those 3 years. And there's certain guidance associated with that, which we're happy to help on some of that language. Just reach out to your source contact person. But those elections need to be made before the expiration of that statute of that return. So for 2022 returns, we're going to see some statutes close on 315 and 415. And then if they extended, we're going to see statutes close based on that extended filing date. So make sure that any elections to go back and amend have to be done by a year from the enactment of the bill, which would be July 6th. 2026, or that statute running on the 2022 return. So keep that in mind. If there is no amendment, and if you are a BBA partnership, you would do the AAR process, correct? And that process would be you could file that at any point in time, obviously before the statute runs. Alternatively, if you're a small business and you still had the 2024 return open, you could do what's considered an accounting method change on the 2024 return. And you do this again, not with a 3115, there's no 3115, but you include a statement in lieu of the 3115, and you would also then compute your 481A adjustment. So you would basically catch up all of your amortization costs and kind of unravel what you did in 22 and 23 on that 2024 return. Now, given that this guidance came out at the end of August, I think it was August 28th or something like that, it didn't give a lot of time for people to really digest and do this. And many taxpayers obviously didn't have the ability to go that route. So many of them are looking at the amendment process. If a small business is amending, there is the 280C election. And if you've worked with the R&D tax credit, when a company takes an R&D tax credit, the credit is taxable per se to the client, where you either take a larger credit, which is considered the gross credit. And if you take that gross credit, you have an add back to income because you have to reduce your deductions by the amount of the credit. So you can either take the gross credit or you can make what is called a 280C election. And if you make that 280C election, you automatically haircut your credit by 21%. So you go to the C Corp statutory tax rate, which is the 21%. So if you're a partnership or S Corp, normally that 21% haircut is much more favorable than losing the amount of the credit through deductions if you could potentially be in a higher tax rate. However, with amortization, the add back was adjusted to be offset by the amount that you amortized. So most taxpayers, if they took the credit and were amortizing in 2022, in 2023, and 2024, would have taken the gross credit. The 280C election is an election that's required on an original return. However, Rev Proc 25-28 is allowing clients to go back and amend returns and take that 280C election. So it makes it a lot cleaner when you go back and adjust for your current deductibility. So just know that that relief is there as well. And that election, again, would be on the same statement that you file when you go back and amend. And again, it's got the same expiration. You've got to do it by July 6th or the earlier of that 2022 tax return expiration. All right. Go over that. Let me see. I've got a couple more slides here, and I think we're going to wrap up with maybe a chance for a question, maybe. Otherwise, we'll definitely get back with you. A couple things for all taxpayers, not just those small businesses. It's starting with you have to actually elect, even though it's a new code section, you still have to make an election on your 2025 return to adopt 174A. And then that would give you your immediate deductibility of R&D expenses starting in 2025. There is an option for all taxpayers, as I mentioned before, to catch up all their unamortized amounts on that 2025 return as well. And you can either flush it all through on 2025. Again, you got to worry about NOLs and other things that then can be limited. So you want to look holistically at a client's tax position if accelerating some of those amortized costs is even going to be a benefit, or if just running through the normal amortization schedule is going to work out best. But 174A still has the option that if a client wants to continue to amortize, they can. And it was similar to the old 174 rules, that is not less than 60 months, that is available. And then I think that's a wrap on that one. I did want to just talk about a couple other things briefly here, and that's how these automatic changes happen. Going to 174A, adopting 174A is an automatic change. So that is on the list of those automatic changes. You do not use a 3115 on the 2025 return. There is just a statement. If anybody is still trying to figure out compliance on some of those back years, we have a number of clients that we're seeing now that didn't realize that they had R&E expenses, or, quite frankly, wanted to take a little bit more conservative view on what their R&E expenses were in those years because of the financial impact to that the amortization was having on their financial situation. So there are some pathways for some of those small businesses to get compliant. And we're happy to talk with you about that. If you're a large business, there really is no cure for those back years. But if what we do suggest with those that maybe were not compliant with the amortization on some of those back years, and you're a large business, is you actually elect on your 2025 return to accelerate any unamortized R&D costs. So at a minimum, you are stopping any additional interest or penalties, right, from not following the amortization in 22 through 24. So I did want to put that out there. I believe that's really here on this last slide. The last bullet here, taxpayers that did not amortize in 22 through 24, and these would be large taxpayers, should really evaluate the need for including that catch-up amortization statement on their 2025 return. Okay. There's a lot more here with some of the accounting methods and the 5-year, rules and this and that. I would just say that given the timing where we are in the presentation, that one-on-one conversations, everybody's tax position is quite different. And we're happy to have those one-on-one conversations and make sure everything's clear. But we were happy to be here today. And I think we have a minute if, Anne, you saw any questions pop up or we wanted to address anything.
Actually, we've got one final polling question, which is, and this is the most important. What is the best holiday film of all time? A, It's a Wonderful Life. B, Die Hard. C, A Christmas Story. And D, Elf.
It's clearly D, but I'm just saying.
I can't argue with that. We only had one question, and I believe John answered it. But if you do have a question in the next minute or two, please use the Q&A function. and we will try and get to it. We will also email this presentation and this recording within about 3 business days. Peter would like to, can you go to the last slide so the contact information is available for all?
There we go.
Thank you.
All right. Thank you, everyone, for joining.
Thanks, everybody.
Take care.
Thank you.